SoFi stock investors were shocked after finding out through LinkedIn that the bank laid off 7% of its employees. That's around 300 employees from SoFi's 4,200 total headcount gone despite the company's great performance in the past year. SoFi stated that the layoff happened because the company was committed to achieving strong GAAP profitability and growing tangible book value. Still, there seems to be more to it than that. This is why we're going to talk about the SoFi layoff in this video, speculate on why it happened, and its impact on the company and the stock. Welcome back to PST Markets. To understand why SoFi laid off some of its employees, we have to understand why these layoffs were never formally announced. We first found out about it when SoFi investors on X pointed out that many former SoFi employees had posted on LinkedIn that they were part of a large layoff in SoFi and that they were currently searching for new jobs. When this was first revealed, investors on YouTube and social media were speculating that the headcount reduction was as much as 7%, which would mean SoFi laid off around 300 employees, since the company supposedly had 4,200 full-time employees before the layoff happened. However, this turned out to be false, as the SoFi investor relations account on X confirmed the layoff but said that the headcount reduction was less than 4% of the company's population. Still, look at the LinkedIn posts. You can see that the company laid off product managers, UX design leads, UX researchers, multiple software engineers, and managers in the loan departments, meaning that this was a broad layoff across the entire company despite being under 4%. Most of the time, layoffs happen if the company is going through a hard time and struggling to meet profitability. But is that the case for SoFi? We don't think so. In the investor relations statement, SoFi said that it plans to continue growing its team in 2024, which isn't a sign of the company struggling so much to reach profitability that it's laying off people. In fact, SoFi's career page on its website offers 47 different jobs in 26 locations, most of them being in the risk department. So, why did the SoFi layoffs happen if they weren't for profitability reasons? To answer this question, we have to look back at when SoFi first acquired Galileo and Technisys, after which a layoff of around 65 employees. That was apparently due to duplicate roles that were basically doing the same purpose, rising after the acquisitions of two companies that were eventually going to combine. In fact, if a company wanted Technisys digital banking services, it'd be directed to Galileo's website. So this integration between the two companies has led SoFi to reduce its employees. Another example of a company doing this for the same purpose is Robinhood, which laid off 7% of its employees in June of 2023 following its $95 million acquisition of credit card platform X1. According to Robinhood's CFO, Jason Warnick, the layoffs happened to help Robinhood adjust to volumes and align team structures better after the acquisition. SoFi could possibly be doing the same thing, especially when you consider the fact that most of the employees it laid off appear to be from the tech and loan side of the business, which is the reason why SoFi acquired Technisys in the first place. Technisys was acquired by SoFi in 2022, and the company provides banks with leading cloud-based core banking systems and digital banking software. Its clients included banks and financial services companies such as Credit Club, GIC Bank, and Relevate. SoFi itself used Technisys services before it saw an opportunity for vertical integration and acquired Technisys for $1.1 billion in order to use its digital banking software services for SoFi Bank technology, and also acquire Technisys B2B clients. The acquisition also allows SoFi to take the digital banking services it used to pay Technisys for in-house, allowing the company to save on costs. In line with SoFi's plans to reduce its costs via this acquisition, this new layoff could be SoFi's first move to complete the full integration of its operations with those of Technisys, especially since most of Technisys' original software team stayed after the acquisition and wasn't laid off. Since SoFi is planning to become a one-stop shop for all fintech services, fully integrating with Technisys is extremely important for the company, especially since the bank is currently working with third parties to provide some of its services, such as its brokerage services, credit cards, checking and savings services, and lending services. Some examples of these third parties are Zillow Mortgages, which helps SoFi issue loans, and Apex Fintech Solutions, which is responsible for SoFi's brokerage side of the business. Notably, SoFi tried to acquire Apex a few years ago, which indicates the company's desire to integrate all its operations vertically. If SoFi fully combines its operations with Technisys, it could take one of the services it goes to third parties for in-house, which would help the company reduce costs and increase profitability. Investors have speculated that it could be the lending service since the layoffs focused on lending department managers as well as software engineers. Besides the integration of SoFi's operations, many have also speculated that SoFi is laying off employees because it is going to automate those jobs by using AI. This also could be the case. So far, SoFi only used AI technologies for features like early direct deposit, transaction alerts, and mobile check deposit for its customer checking and savings accounts. However, it could try to follow the lead of other lending companies like Upstart Holdings, which provides an AI lending platform that allows the company to approve loans almost instantly. This makes sense when you consider that most of the layoffs were in software and lending, but we can't be so sure since the company's AI operations are mostly focused on Connecta, which is SoFi's AI engine and virtual assistant. In 2021, SoFi acquired Kona, a company that specialized in creating banking solutions focused on customer experience, and these solutions included AI-powered chatbots, which is how Connecta was later developed. Being only a virtual assistant, Connecta can only replace employees in departments like customer service, not software, UX, or lending. With all of this in mind, is this layoff a bad sign for SoFi? We have to wait until the Q4 earnings call to have all our questions about the layoff answered. Still, we think that the sole reason for this layoff is SoFi's full integration of its operations with Galileo and Technisys. The company's main plan to achieve and maintain strong profitability seems to be developing its technology platform segment, which includes Galileo and Technisys. This was emphasized in the Q3 earnings call, when SoFi's management promised a better performance for the segment in Q4 and in 2024 as well, especially since the technology platform only saw slight growth in 2023. The technology platform segment saw revenue in Q3 of $89.9 million, resulting in a slight acceleration of 6% year-over-year growth. If you consider the full integration of SoFi, Galileo, and Technisys that could have caused the layoff, as we speculated, then management's comments about expecting the technology platform's revenue to continue to accelerate into Q4 and into 2024 makes sense. Also, during the earnings call, management said that SoFi signed new clients, which would help increase the revenue of the technology platform segment. We also shouldn't think that this layoff is too worrying. In the tech sectors, many companies such as Amazon, Spotify, Duolingo, and Netflix have been laying off employees lately. There are two reasons why layoffs are so present in the tech sector now, one of them being companies switching to AI to automate jobs, or reversing what happened during the pandemic when tech companies overhired thanks to the massive growth of online services like online shopping and working online. Maybe SoFi was one of the companies that hired more people than it needed during the pandemic and is now simply trimming the fat, which isn't unhealthy for the company. If this is the case, then this was a good time to do so since Q4 already ended, and the layoffs wouldn't affect the company's financial performance or profitability in that period. Additionally, the company supposedly offered the employees it laid off severance checks for 3 months, so the layoff also probably won't positively impact 2024's Q1 profitability. However, SoFi only laid off less than 4% of its employees, which shouldn't ring alarm bells. A truly worrisome layoff happened at gaming company Unity Technologies when it laid off 25% of its employees. This resulted in an 8% drop in new stock. On the other hand, SoFi stock saw a 1.92% increase since the news, and it even outpaced the S&P 500's daily gain of 0.57%. In addition to that, SoFi stock, which currently trades at around $8.05, received a price target of $11 from Deutsche Bank the same day the layoff was officially announced, with Deutsche Bank stating that if SoFi wants to become the Amazon Web Services of banking services, it will need to return to the strong growth in its technology platform segment, which seems like what the company is trying to do. So when you put all of these pieces of information together, we can say that the layoff is a bullish sign for SoFi stock investors, as sad and unfortunate as it is for all the employees who lost their jobs. Thanks to this, we think that SoFi stock, which gained 116% in 2023, could offer a great investment opportunity for investors who want to enter the large fintech market, so buying or holding SoFi stock might be a smart idea. Well, that is everything for now. What do you think? Will you be buying SoFi shares? Please let us know what you think in the comments below. And if you haven't, please subscribe and leave a like for this video. Your support helps us continue our work. Thanks again for your support, and I will see you in the next one.